I'm not going to waste your time, so there will not be an intro. Instead, what we're going to do is we're going to look at the request that prompted this video, which is by SDP_3. Any chance you might update this excellent information referring to how to open and close a trade in Etrade, a video I made 5 years ago, using the current Etrade platform. So the platform has changed. Indeed, it has. And going in here, I found that it does look different from what I saw in my last video. Essentially, what you want to do is open your Etrade account, go up to trading, and then select what you're trading. So I'm going to show you two situations. One is stocks ETF, and the other is options. I'm going to show you how to open and close the trade. So, opening the trade, put in your ticker. We'll do applied materials. AMAT. Once you put that in and hit enter, you're going to get the quote, the price, and importantly, the bid and the ask, as well as the sizes and the volume. Now, we are opening a trade, so our action down here is going to be buy, if you're buying the stock, and sell short if you're shorting the stock. Those are the two choices you need to make if you're going to open a trade. If you want it to go up, you buy. If you want it to go down, you sell short. This is the key area that we're talking about today, both in stocks, ETFs, and in options. It's the action. The action determines whether you're opening or closing the trade. When you open, you buy or you sell short. So here's the situation. We're going to buy 100 shares, price type. Now, these price types are going to be dependent on how exactly you want to enter. If you're trading a stock that's very liquid, where the bid and the ask size are very close. Here we see them only about 10 cents away from one another. In that case, if you select market, what you're going to get when you buy the stock is the stock at this price. Now, it's possible you can get it close to this price, and to do that, what you would do is choose a limit order. And what I like to do is start with the best possible price I can get, plus a few pennies, because you're not going to get the bid price. If the bid is right there, and that's the price you're looking at, it means it's not being filled. It means no one's willing to sell for that price. But it doesn't mean that people aren't willing to sell for a little bit more than that price. So I usually try a little bit above, maybe round up to the next 0.05, or to the next 1.0, which would be 2 in this case. But that's too close to ask. So here's what I would probably do. I'd probably go with 0.15 and set good for the day and preview that order. Now, if you want to set that order out for maybe 60 days, you can do so. Generally, I just go with good for the day. And all or none, by the way, is sometimes important, but usually not. What you're doing with this all or none button, you're toggling it if you want to be ensured that you're going to get all 100 of this quantity at this limit price that you've set. If you don't care about having to make 2 trades, which will be automatic, by the way. For example, let's say, it's not always automatic. Scratch that. Let's say that you put this limit price in, and you don't click all or none, and only 50 people want to sell that stock to you at this price. You're going to get 50 filled, and you're going to have to come back and raise that limit price a little bit, go through the order again. Now, what is that going to do for you? It's going to give you 50 shares bought at 141.15 and 50 shares bought at 141.2. Well, that's better than getting them all at 1.4 or 1.2. But obviously, if you really need to get filled at exactly that price and you can't accept having to put in another order, then you go with all or none. But in general, just leave it blank. So this is what I'd put in. I'd preview order, then submit order. And once you do that, you've got that 100 shares of stock in your account. And now you're going to want to close it. All right. Now, let's say we're selling short. Same stuff. The only difference here is selling short. When you're opening this trade, sell short. The only difference is this ask and bid here. If you're selecting market, you're selling at the bid price. That's the worst possible price you could sell at. If you want to get a better price, you start from the ask this time and go down slowly. So I'd start at 141.2, and if that doesn't get filled, 141.15, slowly move down toward the bid price. Usually you'll get filled at around the midpoint between the bid and the ask, but sometimes you can get filled really close to the ask or really close to the bid in the case of buying stock, and that saves you a lot of money down the line if you're making frequent trades. All right, so let's say we already bought this stock. Now, how do we close that trade? Well, all you have to do is select short. It's all about this action button here. You bought the stock just like this. You're ready to close the trade. You sell it. Hopefully, it's going to be more expensive than when you bought it. So, boom, you're done. That's it. Send that order through, and you've sold your stock. Now, in the case of shorting, let's say you sold short, and you're ready to close that trade. You buy to cover. No, it's pretty simple. Buy is opening a trade. Selling short is opening a trade. Selling is closing your buy trade, and buying to cover is closing your short trade. That should be pretty clear. Let's move on to options. Let's do the same thing. Aim at. Okay. So in options, you have a lot more choices than in stock. You have all of these. I'm not going to go through all of these. So I'm just going to show you the example of, why don't we do a spread, we'll do a call because that's more simple. And then maybe we'll look at spread in a minute. All right, so call. And again, just like we saw in the stock example, the key point is this action. Now, when we're opening a trade, we always choose open for options. And when we're closing a trade, we always choose close for options. So a lot of people get confused about this stuff. But I'll show you right here. You're going to buy a call, you buy to open. Never buy to close. You sell a call, you sell to open. Never sell to close. This is how you open a position. When you're ready to sell the call that you bought, then you sell to close. Now, if you sold a naked option, and that's your opening position, for example, you're not holding anything in AMAT, and one day you decide, I want to sell some calls because I think this stock's really not going to rise from here. You just sell some naked calls, you go through that with that trade, and you're ready to buy them back. When you buy them back, you close the trade because you're negative whatever, 10 calls, negative 1 calls in your account, and you want to make that negative go to 0. You enter the quantity of calls you're negative and buy to close. That's pretty much it. It's all about this action here. Opening a trade, always buy to open, sell to open. Closing a trade, always buy to close, sell to close. And just for good measure, we'll go through with all of these options because sometimes you don't know. So here's what we're going to look at. Quantity, the number of contracts you want. Remember, 1 equals about 100 shares of the stock, the equivalent. So when you're looking at these prices, you always need to multiply it by 100. You want to buy the AMAT, we're opening a trade, buy to open, the AMAT option of this expiration, this strike, and this call. In that case, these are your bid and ask, but you're going to pay 100 times that. So it looks cheap, 50 cents. Actually, it's not 50 cents. It's going to be 50 bucks. All right, so just like when we were buying stock, we are going to try to get the best price we can between these bid and ask. Expiration, that's when the options expire. We're going to go out a week, let's say. Strike, at the money is closest to what the stock is trading at. So at the money would be 141. In the money for a call would be lower than that, like 140. Out of the money would be higher than that, like 142. Now we see the bid and the ask. Spread is about 30 cents. That's unacceptable for me, so I'm not going to choose a market price because if I chose the market price, I'd be buying at 221, whereas I can obviously get it a little bit closer to 1.95 with a limit order. So I'd start, like I said in the other example, start by moving up in increments of 5 pennies, which is actually $5. So I'd start with 2.00. Good for the day. Again, all or none only matters if you're buying more than one. I really want to get those two at this price, then I'd go with all or none. If I'm happy with just getting one filled, maybe I wanted to buy 2, but I'm fine with just getting 1. That's what I'd go with. Okay, So in the situation of going through this order, previewing, submitting, now I want to close it. I just sell to close. All this information is the same, but just like shorting a stock or selling a stock, you want to get as close to the ask price as you can. You want to get the highest price you can for this option when you sell it. Hopefully it's going to be really high, $300 million. But if this is your quote you got right here, you're going to want to start near the ask. You might put 2.20, wait a little bit, see if the stock fluctuates and hits that price, or a little more conservatively, go to 215. And if you really want to get it filled quickly, but you still want to use a limit order to get a good price, maybe go toward the midpoint of the bid and the ask, and you'll usually get that filled. All right, so that covers options. Let's look at other strategies, because the last video I made, I was talking about spreads. I think I'll cover that last, and that will end the video. So when you're doing a spread, what you're doing is you're buying one option and you're selling another option, and they have the same type. They're both calls or they're both puts, and they have the same expiration, but they have different strike prices. So what you're doing essentially is you're trying to make money on the sold. Not always, huh? Well, in this case, let's do an example here. Let's do a put spread. Let's do a put credit spread. So what we're going to do is we're going to believe that the stock is going to go up. All right, so we're going to believe that the stock is going to go up, and we want it to go. Here's a good example, actually. This is a pretty common type of spread, and I think a lot of people will find this to be useful. So we're going to start out of the money. Both of these strikes on puts are out of the money because they're lower than the last price of the underlying. So that means there's no intrinsic value for either of these puts. We're going to buy the lower strike and sell the higher strike. Now we're selling puts that are close to this strike, close to the actual price of the stock, but not actually in the money. In other words, they're worth money, but they don't have any intrinsic value. So if AMAT trends sideways, then they will expire worthless and we'll have some capital gain there. It's just selling a put in this case. But the difference here with the spread is we also have a put that we buy below that, which gives us protection. In other words, if the stock falls under 135, we're protected by this put. This bought put acts as insurance. So what we're doing here is we're opening this spread as a credit. You can see the bid and the ask, and the midpoint is calculated for us already. Because when you're trading multiple options, it's harder to get close to the ask for a credit spread and close to the bid for a debit spread, because you have to get both of those filled at the same time. So usually you want to try around the mid. What I do here is I do net credit, because we're going for a credit. Credit means you get money right away. You're selling something and your goal is to profit immediately from the cash gain, and hopefully your options will expire and you'll keep that credit. Debit is the opposite. Debit is you're paying money for that position. So we're going to do net credit because we want to get paid $151. I'm just going to round down a little bit, and everything else is the same. Preview order, submit order, estimated proceeds $150. So what this is essentially is a sort of gamble. We're saying if AMAT is above 140 by October 8th, by the expiration, then we get to keep this money. Otherwise, we have to calculate how much we're to lose, which is essentially $100 per $1. It's below 140 by that date. And you can hedge your risk. You can change your risk profile by buying different types of insurance. Here, obviously, we only have $1 risk, the difference between the strike prices, but we only get 40 cents profit. All right, so if you're interested in that, I'd say look up some info on credit spreads. They're pretty useful. They allow you to profit in two directions, sideways and upwards in the case of a put spread, or sideways and downwards in the case of a call spread. Now we're going to look at debit spreads, which is still a spread. We're going to look at a put debit spread, which is just the opposite, essentially. We are going to switch the strike prices so that the bigger strike is the one we're buying, and the smaller strike is the one we're selling. Okay, so here what we have is another buy to open. Remember, we're always buying to open. We're buying to open a 141 strike put, and we're selling a 150 strike put. Now, the bought put isn't at the money put, and usually at the money puts are fairly well priced, fairly priced, but you can lose a lot of money, and some people will think they're kind of expensive based on whatever the expiration is, because these options have time decay, and if the stock doesn't move fast enough, well, you could lose money even if your prediction in the direction was correct. So what we're looking at here is a way to kind of hedge that time decay in a way, and also just make the outright price of a at the money put cheaper, because at the money put costs around, let's say, $3.25 each. But if you're selling these puts below, these are out of the money puts, you're selling these below, you can get a discount essentially. You can get a $130 discount on this, and instead of paying $3.25 or whatever, what you're paying is more like $2. Now the downside of this is simply that if AMAT falls below the strike price of that sold put, you're not making any additional gain. So your max gain here is the difference between the strikes, $6 or $600. So if AMAT falls really hard, if you had bought just the at the money put, you'd be making a lot of money, but in this case you're only making $600. However, you paid considerably less than the person who just bought the at the money put outright. Now putting the order in, same process. Main difference is the price type here needs to be net debit. And in Etrade it'll tell you, look at this midpoint, it'll tell you whether it's credit or debit. Switch these around and it's going to show you it's credit. You always want to go with what the midpoint is around there, and make sure that if it says credit, switch to credit. Alright, let's take a step back and assume we have bought this credit spread. This is now a credit spread. We bought this credit spread and we want to close it. What do? Same as if you were treating these options individually. We bought this one to open, so we want to do the opposite. What's the opposite of buy? Sell. What's the opposite of open? Close. Sell to close. We sold this one to open. We want to do the opposite. What's the opposite of sell? Buy. What's the opposite of open? Close. Now, this is going to turn it into a debit, right? So, we want to close at a debit, which means we got money immediately because of the credit. We got that premium, it's called. And now we're going to pay a little bit to close the position. Hopefully what we pay is less than what we got at the beginning. All right. Now let us go back to a debit spread. Now we're at a debit spread. We want to close this debit spread. So we already know that that's going to be a credit. Sell for a credit. Whenever you type credit in here for price type, you're getting money. Whenever you type debit, you're spending money. So we're going to do this for a credit. Now our actions need to be the opposite of what they were when we opened the position. What's the opposite of buy? What's the opposite of open? We're going to sell to close. What's the opposite of sell open? Buy to close. And there we are. We've got a credit. Credit's around $2. We put that order through, and we just made profit on our debit spread. So I think that pretty much covers it. I mean, of course, we have all these other strategies we can look at. If you have one of these strategies you would like to get clarification on, let me know in the comments section below. And I think that pretty much covers how to open and close a trade in Etrade. Please subscribe. I'm trying to get my subscriber count back up to 10K. I'd really appreciate some subscribers. And let me know if you have any questions or video requests. Thanks, guys.